guest today, Frank Gill. He is with S&P Global Ratings. Frank, welcome to Bloomberg HT.
Thank you.
Turkey's central bank raises interest rate less than expected to 17.5%. Overall, can you talk about the Turkey's economic outlook?
Yeah, absolutely. So really up until the elections, which took place earlier this year, the key policy objective was really supporting growth, in particular private consumption. And I mean, Turkey in many ways is a textbook case of an overheated economy. You had a very high stock and rapid growth of consumer credit, very high private consumption, obviously very high headline inflation, and a current account deficit, which in 12-month rolling terms in May was about $60 billion, and the funding was increasingly unreliable. So the challenge going forward is obviously to engineer a soft landing of the economy, to bring down inflation, to try to bring back or reaccumulate FX reserves, stabilize the currency, and to do all this without undermining financial stability, so without really hitting the banks very hard, and without a serious weakening of the fiscal position. It's a very challenging situation.
So what do you think about the inflation, let's say, till end of this year, and also the Turkish lira, your expectation?
Yeah, so I mean, we're not expecting really a major pace of disinflation. I mean, I think 12-month inflation is just under 40% right now. We think it's probably going to remain close to that level for most of the rest of 2023. Then we're predicting disinflation getting started in 2024, 2025.
Mm-hmm. And also key risks to the B+ sovereign credit rating. And what is your thoughts on the credit rating?
Yeah, so Turkey, actually, we have a single B rating on Turkey. We have a negative outlook. We do think that it's that there is a policy resetting taking place. You have a new economic team. We think that they're very serious about trying to bring down headline inflation, trying to bring down the size of the current account deficit, and without hitting the banks too hard. We just think it's very challenging to soften demand. Usually when you bring down private consumption, it often hits the fiscal position of the government. So it's quite a tricky balancing act, to be honest with you.
Mm-hmm. And what are the implications of current macroeconomic environment for the bank's asset quality, Frank?
Well, I mean, we think the good news is that even compared to a year and a half ago or 2 years ago, that there's not as much of a mismatch of interest rates on banks' balance sheets, especially the private banks. So obviously the funding costs of Turkish commercial banks have actually increased considerably even before the elections. The cost of deposits and other funding has risen, but they've been able to reprice the asset side of their balance sheets relatively quickly. Again, I'm referring mostly to the private banks. We don't have a lot of visibility on the balance sheet of the public banks. But despite that, I mean, I think with the exchange rate volatility we continue to see, you've had 30% depreciation of the lira so far this year, and the cost of funding increasing. It is a difficult environment for banks going forward. They also last year were subject to multiple measures, including in some cases measures intended to reduce their FX positions, and also to essentially force them to purchase government paper at negative real interest rates. And these sort of measures that we would describe as financial repression can actually weigh on profitability of banks and can hit their financial strength.
Mhm. Do you think that raising interest rate would impact the banks? I mean, right now Turkish Central Bank increases the rate, not too high, but overall, when you look at the banking sector, how do you see the interest rate linking to the banking sector?
I mean, again, we feel like the private banks in Turkey are quite well positioned. They were ready for this. They recognized that there was a high probability that after elections there would be essentially a normalization of monetary policy, and that they have been shortening the average maturity of their assets of their loan book in expectation that they would want to basically reprice their assets and reflect higher rates. So we do think for them it's manageable. Again, for the state banks, which we don't have ratings on, we have less information in terms of their ability to adjust the asset side of their balance sheet to higher rates.
Right. And my last question, Frank, overall emerging markets, when we look at the global economy right now, still recession discussion, energy problems continue, Russia-Ukrainian conflict in the region. What is the three key highlights on the emerging markets within 3 to 6 months? What do you think?
Well, I think the good news for emerging markets, especially those rated at BB or higher, is you're actually seeing a very strong recovery of capital inflows into domestic government bond markets in places like Brazil, Colombia, Mexico, across Asia, Indonesia, and into Hungary and Poland in EMEA. I think that's partly because the view is that central banks in those particular countries have been ahead of the Fed in tightening the key policy rate. I think, unfortunately for Turkey, the policy rate settings, we've had very deeply negative real interest rates. And so today, Turkey's not really benefiting from that inflow of capital yet. But we do think the new economic team is trying to find ways to bring capital back into the country. I mean, we have a trip this week to the GCC, to Saudi, to try to look at the potential for Saudi investments in the Turkish economy. Turkey's economy is one of the most resilient economies in emerging markets. It's very open. It's quite complex, high value added sectors like white goods. So it's certainly a relatively competitive economy, big tourism sector. So it does have advantages.